Hi, I'm Kylie and welcome to this week's episode of Money, 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 where we cut out the jargon and talk about all things financial. Hi, and welcome to this episode of Money, Money, Money. At the local loan company, we often deal with clients who have a requirement for lender's mortgage insurance. So here to help me explain it today is the friend of the local loan company and industry expert, Ray Hare. Welcome, Ray.
Thank you,
Thank you for joining us. What is lender's mortgage insurance?
Okay, so lender's mortgage insurance, or LMI as it's often referred to, is really a transfer of risk from the lender to an insurance company to allow or facilitate that lender lending to borrowers that have a lower deposit. So traditionally borrowers are expected to have about a 20% deposit on to buy a house, and LMI allows the lender to lend to borrowers with less deposit.
Okay, so who's actually insured? Is it the lender or is it the borrower?
It's really, really important from a borrower's point of view to understand that they are not the insured party. It's not about covering them, it's about covering the lender, and it covers that lender for the risks of that borrower defaulting.
Okay, so make sure I've got it right. The borrower is paying for the lender to be insured.
Yes, that's right, where the lender passes on the premium, and in most cases where LMI is charged, which is where the loan amount or loan to value ratio, LVR, is higher than 80%, then the borrower will usually have to bear the cost of that LMI premium.
Sure, but without paying it, they wouldn't be in the industry. They wouldn't be not in the industry. They wouldn't be in the market, would they?
Well, that's exactly right. So traditionally, of course, the banks and lenders have sought to be fairly conservative. Obviously, it's a large financial transaction when a young couple or borrowers are borrowing a house, particularly their first house. And statistically, where there's less equity in the property when the loan's taken out, that's the borrower who is at a higher risk of defaulting and not being able to maintain those repayments.
So it's not only first home buyers that have lenders mortgage insurance, it can also be for investors or perhaps those upgrading their home with not enough equity. Is that right?
Exactly, Kylie. In fact, all loans can be insured. Investor loans, first home buyers, second properties, upgraders, etc. And it really is around the bank or the lender as to which loans they want to insure. Some lenders, for instance, where they source their funds from the wholesale market, and we call that securitisation often, all of their loans are insured, but often they only pass on the cost of that insurance when the loan amount is more than 80%.
Okay, so LMI always applies to 80% and above, or can it sometimes be lower?
It can apply at a lower LVR, and it doesn't have to apply at all. There are some lenders who don't insure their loans, they self-insure, they take the risk on balance sheet, and those lenders may well charge what they call a loan protection fee to the borrower, which is really their premium.
It's a form, isn't it? A form of
exactly.
LMI, so just by a different name.
Correct.
Okay, so is it refundable at all? So if I've bought a house, don't like it, want to move out within 12 months or 2 years, is my LMI premium refundable? In
very limited circumstances. So the scenario would be, as you just said, I seek to upgrade my house, so I sell it, or indeed I just refinance and repay that loan and move it to another lender. Remembering that the lender has insured you as the borrower, not yourself. You aren't taking out the insurance policy, so you can't take that policy elsewhere. It sticks to that original loan, and it's technically paid for by the lender, even though the lender may pass that cost on to you as the borrower.
And that's a bugbear of mine, that you can't take it with you from lender to lender, because if the client has paid the premium and they can't take it to another one because they want to refinance, I've always never truly understood why that's not applicable, but it's because the lender in fact is paying it and passing on the cost.
Yeah, look, it's a common complaint and I guess a common misunderstanding. The transaction is that the lender is insuring you as a borrower. The fact that the lender has passed that cost on to you as a borrower does not make it your policy, and it's insuring a particular loan and at a particular time for a particular circumstance. So to then transfer that to a new loan, even though the borrower may be the same person and their circumstances may well be very similar, it's still not the same transaction.
Okay, so that sheds a bit more light on it.
Yeah, and also remember it's a one-off premium. It's not like you're renewing annually or anything like that. see which case maybe you could take it with you.
Yeah. And what is the actual cost of LMI?
Well, it varies greatly in terms of the nature of the loan, the value of that loan to the value of the property. So that what we talked about, the loan value ratio, or LVR, is a big driver of that cost. And once you get above 80%, that's when the cost starts to really kick in. Around that level, it's kind of around 1% of the amount being borrowed, but it quickly rises at 85 and higher. It starts to really become quite a significant cost.
Yep. So quite a way through this, we've been referring to LVR, which is loan to value ratio. Yep. Can you explain that really quickly?
Sure.
Because we're trying to cut the jargon out.
Yeah, okay, I understand. A $500,000 property, if the borrower borrowed $400,000, that would be an 80% LVR. So the $400,000 loan is 80% of the value of the property at $500,000. So the loan to value ratio is 80%.
Okay, that makes it easy. How do you arrange lender's mortgage insurance?
Well, generally speaking, it will be the lender or the broker. So the borrower coming to the local loan company would obviously seek your advice as to what loan best suits their purposes and circumstances, and in advising them of what's required and understanding what their deposit is, you would then be in a position, and the broker would advise the client that LMI is going to apply at this level.
Yep.
And be able to make a very accurate estimate of the premium before submitting the application.
Okay. Now, if borrowers are having difficulty meeting their repayments, what do they do? Because this insurance is meant to help, correct?
Well, it's really important again to understand that this insurance, LMI, is not there to help the borrower. It's to facilitate the lender lending to a borrower that might not otherwise have got a loan from that particular lender, on the basis that they're overextended in a sense to the value of the property. So they transfer the risk from the bank or the lender to the insurance company. So if the individual borrower then finds that for any number of unforeseen circumstances, which is why they might have their own personal insurance, of course, for those unforeseen circumstances, they might find they're in financial difficulty and can't meet the repayments. They clearly need to move quickly on that, talk to their broker, talk to their lender, and seek to mitigate any loss that's going to arise. Because at the end of the day, what LMI does is it meets the shortfall on sale of your property if the loan isn't paid out in its entirety. And even then, the LMI insurer can, of course, still go to the borrower to seek.
Yeah, we've heard a few times that where someone will actually say, "Oh, it doesn't matter if I default and the house gets sold because the mortgage insurer is going to pay it anyway, and it doesn't matter." And we've stressed it does still matter. The lender's mortgage insurers are still going to come chasing you.
You're not
for their shortfall. That's
right. The liability still sits with the borrower, or indeed the borrower's guarantor.
Yeah,
and that can obviously be a difficult situation.
Yeah. So communication really is key, isn't it, to a good working relationship?
I think identifying the problem early and seeking assistance early is the key, yes.
Yeah. And just last question, because you raised it earlier where I'd asked you a question about lender's mortgage insurance, am I protected? A lot of people are confused between lender's mortgage insurance and mortgage insurance. Can you just very quickly just explain that?
So I think it's about understanding who the insured party is. So the lender insures the loan, that's LMI.
Yep.
For a borrower who has to meet those repayments, they need to think about income protection insurance, life insurance, sickness and accident, trauma type insurances. Mortgage insurance or mortgage protection insurance is about the individual borrower, and that's very much around the individual circumstances and requires its own advice.
Yeah, so that's really then just ensuring that your repayments are met for a specified time until you're back on your feet, or...
Absolutely. I mean, it's every Australian's dream, of course, to have a house, but at the end of the day, to have a loan that can't be repaid and not to have a roof over your loved ones' heads, should you be ill for reasons of no fault of your own, that would just make that whole dream become a nightmare.
It's a whole nother subject for money, money, money.
Sure
so
is.
On that note, thanks Ray for sharing those insights with us today, and we look forward to joining with you next time on Money, Money, Money. Thanks for watching Money, Money, Money. If you liked this video, hit the red subscribe button. If you'd like to know more information, you can follow us on Facebook or go to our website, linked in the information box below.